Today, we're going to talk about early retirement and how it may or may not affect you. Over the last 4 years, Iconic Insurance has become experts in the field of helping people retire early with regards to their health insurance. First things first, what do we mean by early retirement? Early retirement simply means retiring from your job that gives you health insurance benefits before you reach the age of 65. Because once you reach the age of 65, you're eligible for Medicare. And as long as you get a good supplement, maybe a dental and vision plan, a good prescription drug plan, you're home free. The health insurance doesn't get that complicated. But prior to hitting Medicare age, there are so many options. And a lot of people who fit into this bucket, whether you're in your 50s, late 50s, early 60s, who want to retire early, haven't reached Medicare yet. A lot of these people have had health insurance through a job, and they have not had to shop for health insurance in years, decades, or maybe even ever. So we step in, we help and show them what their options are based on their situation, and then we take them to the market and we help them sign up for it. And then once they hit 65 and they're on Medicare, they're home free. What we're going to do is we're going to talk about Iconic Insurance's role when you may or may not want to retire early and what type of health insurance options you'll be looking at. So first things first is we'll ask you to fill out a form. It's going to have your name, it'll have your email address, and what we'll need from you is your zip code and your projected income upon retirement. And so this may seem like a weird question to ask, but there are plans on the individual health insurance marketplace that are income driven. So why it's important for us to understand what your income is because a lot of these marketplace plans are going to be income driven when it comes to their premiums. So the less money that you make, the less money that you show on paper, the larger a tax credit that you will get on the Affordable Care Act to help pay for some of these health insurance premiums. So a lot of people upon retirement, especially if they're retiring early, maybe they're not drawing distributions from their 401k yet. Maybe their pension hasn't kicked in yet. Maybe they're waiting to take their Social Security income. And so on paper, the household income is really low. Well, guess what? That leads to a much lower health insurance premium for you while your income is lower. So take, for example, two 62-year-olds in a zip code of 46032. So we've got a 62-year-old wife, 62-year-old husband, zip code 46032. Now, this is a portal that goes directly to Affordable Care Act marketplace plans. And if we scroll down in this particular zip code, we've got 89 different plans. Don't worry, we're not going to sit here and go through 89 different plans, but you'll see they range from $1,550 a month, and they go all the way up to $3,400 a month. And now you might be sitting there thinking, Affordable Care Act, this seems more like the Unaffordable Care Act, and quite honestly, if you were paying full price, I would completely agree with you. But like we said before, a lot of times when people retire early, their household income goes down drastically. And that's why I haven't filled this in yet. So I recently met with a couple who was in this zip code, and their household income upon retirement was going to be $70,000 a year. And you'll see this over here on the right side. Look at that. Estimated savings. So what this means is this couple, if they make $70,000 a year in this zip code on paper, they will receive a $1,366 a month tax credit. That's nearly $16,000 a year to help offset their health insurance premiums. Now, when we scroll down, that $1,550 plan is now a much more affordable $185. And even the most expensive one only goes up to $2,000. But before we get in too far into the Affordable Care Act and tax credits, one thing we always want to go over first is COBRA. So you may have heard of COBRA before, you may have even used it before on your own, but I want to explain a little bit about what COBRA is. Because when you choose to leave a job, or if you are fired from a job that has offered you health insurance, you will be offered something called COBRA. A lot of times people think this is a separate health insurance plan, but it's not. That's simply a continuation of the current benefits that you have through that job. The only catch is, instead of just paying what you pay out of your paycheck to get that coverage, you have to pay not only your portion, but also the employer's portion, plus a 2% administrative fee for your COBRA premiums. This amount can range anywhere from $1,200 a month all the way up. I've seen one be as much as $2,500 a month just for a couple. Now, that doesn't make a whole lot of financial sense to retire early and pay those types of COBRA premiums, especially if you're only 62 and you've got 3 years to go till you hit Medicare, because COBRA also lasts only 18 months. So in this example with this couple who are 62 and 62, even if they had enough money saved up to take COBRA for that 18 months, they'd still have to make another health insurance decision once COBRA expired because they still wouldn't beat a Medicare age at 65. Please keep in mind, I don't mean to say that COBRA is a bad option. It's just almost always going to be your most expensive option, but there are still good things about COBRA. I often will recommend COBRA to people who are within 18 months of retirement because you don't want to go through the hassle of having to pick a new health insurance plan when you can just keep the same insurance you've had forever as long as you can afford that premium to get you to Medicare age. I also recommend having COBRA if you're in the middle of treating for something, because typically changing your health insurance in the middle of receiving treatment just causes mass confusion, double payments of deductibles. It's just not in your best interest. But if you have longer than 18 months until you reach 65, and you're not currently undergoing active treatment for anything, COBRA is usually not the best option, and that's where we're going to want to look to the Affordable Care Act. So you may be thinking to yourself, great, I'm ready to retire right now. I'll just get on one of these $185 a month Affordable Care Act plans and everything will be great. But that's where Iconic Insurance's specialties really come in. Because just because you can get a plan that you can afford does not mean it'll be the right plan for you. What you also need to consider are your doctors, your prescriptions, your hospitals, your travel habits. All of those things need to be factored in when we're talking about putting you on a new health insurance plan. The coverage that you've had through your job is undoubtedly something called a PPO. The PPO is a network designation, and it stands for Preferred Provider Organization. What that means is you have in-network benefits, but you also have out-of-network benefits. It's just if you happen to see an out-of-network provider, you pay more with higher deductibles, co-pays, out-of-pocket maximums. But you could take that PPO plan anywhere for care in the country. Unfortunately, most, if not all, of the Affordable Care Act plans are something called a limited network. So the PPOs don't really exist on the marketplace except in very select states. The majority of the networks are going to be something called an EPO or an HMO, which stands for Exclusive Provider Organization or a Health Maintenance Organization. What those network designations mean is you have coverage inside your network where they allow you to go, but you have limited to no coverage outside of the network. And a lot of people who retire early, they want to travel. They want freedom of choice. They want to be able to go wherever they want to go and not have their health insurance dictate where they can receive health care. For that reason, it's really important to speak to an expert when utilizing the marketplace because we need to make sure that your current physicians are in the network, that your current prescriptions are covered under these plans, but also that if you plan to do a lot of travel, or if it's really important to you to be able to seek treatment outside of your network, that we add the appropriate supplement to your plan to make sure that you're covered in network and out of network. Another thing that a lot of people find important are dental and vision plans. Sometimes when you leave a job, it makes sense to use COBRA for just your dental and vision, but a lot of times it's going to make sense to just do a clean break from the company's health insurance, get on an Affordable Care Act plan to make sure your pre-existing conditions are covered, your prescriptions are covered, and your doctors are covered. We add a supplement to make sure that you're covered outside of the network, and then also with Iconic Insurance, we offer all different types of dental and vision plans. So we typically recommend that our clients simply go into their dentist's office and say, hey, I'm shopping for new dental insurance. What kind of dental insurance do you want me walking in here with? What's going to get me the best care? And then we just sign you up for that plan because we don't have a dog in the fight except for your satisfaction with your dental insurance plan. So if we keep going with the example of the 62-year-old husband and wife in the 46032 area code with a $70,000 income, they may have some prescriptions or some doctors or hospitals that they want to make sure of. So we're headquartered in Indianapolis, so we're going to use a local Indianapolis hospital called St. Vincent, and we're going to plug this in because maybe Mr. and Mrs. Smith, maybe they always go to Ascension St. Vincent. Maybe that's their main hospital of choice. So we want to make sure that's in network. So we would put that in network, and maybe Mr. Smith takes an expensive medication, something called Mounjaro. And those are really important to make sure that those are in network too, and that those are being taken care of and paid for. So this will really allow us to narrow down our choices. As you can see, in the state of Indiana, this Anthem plan is actually quite limited in where you can take it because this isn't the Anthem PPO that you might be getting from a job. This is the Anthem HMO that's going to show up on the Affordable Care Act. So you can see right here, the local hospital doesn't take this plan and the prescription isn't covered. So we would go over here, we'd uncheck the Anthem, and we'd check all these other ones. And basically what we're trying to do here is narrow down the different plans that are available to make sure that the hospital is in network and that the drugs are covered. And so you'll see this plan here, CareSource is taken at St. Vincent, and the drug is also covered. The Mounjaro right here is covered. You'll see down here the Ambetter is taken at the hospital, but the prescription's not covered, so we can kick out Ambetter. Now we take a look at Cigna. Cigna doesn't take the plan at the hospital or the prescription being covered, so we uncheck that one. We scroll down, we'll see the same situation with this company called Aetna. They don't cover the hospital or the drug. It's really kind of looking like CareSource probably our go-to here. But let's do our due diligence and let's see. Ascension Personalized Care. So Ascension takes this plan at Ascension St. Vincent, and there's also drug coverage for that one. So just because the drug is covered does not mean that it's covered well. So if we zoom in here, you'll see green is good. Green means that the drug is in the formulary. But this is saying that this expensive auto-injector has no charge after your deductible. Well, look how high this deductible is. That's not really very good coverage if you're asking me. So we want to scroll down until this no charge after deductible actually becomes a copay. You might think that this is a good one to go for because it has a $50 copay after deductible, but again, look up here. You've got a $7,500 deductible to hit. I think we can do better. So if we keep scrolling down, this one has a no charge after deductible. We're looking for just a straight copay on this. Oh, there we go. Just as I suspected. So this one has the CareSource Marketplace Silver. It's a silver plan. The monthly premium is $610 a month. It has a better deductible. It's got good copays, but most importantly, Mr. and Mrs. Smith's hospital selection is in network. And they also have a $40 copay for this Mounjaro auto-injector, which retails at over $1,000 a month. So this plan with this specific medication and this specific hospital is going to be the best selection for Mr. and Mrs. Smith. So when thinking about whether or not to take COBRA, let's look at a real-life example of a couple that I've helped. There were two 62-year-olds deciding whether or not they should retire early. And in their financial plan, they had as a line item $2,500 a month for health insurance and health care costs. This was based off a COBRA offer of Mr. Smith's job for a little over $2,000 a month in COBRA costs. So not only is COBRA not a good option for them simply because of the cost, as I'll show you an alternative here shortly, but also due to the length of time that they can take COBRA. It only lasts up to 18 months, and if they're both 62, that's going to fall short of the age of 65 when Medicare coverage kicks in. So now let's see how the Marketplace plan plus a supplement plus dental and vision matches up with COBRA. If you remember from earlier, COBRA was $2,000 a month for Mr. and Mrs. Smith. When we then look at the CareSource plan that we selected that covered his medication and covered the local hospital, it was $610 a month. Now, a lot of you might be saying, whoa, $1,400 a month in savings and the prescription is covered, we're good to go. But I do want to caution you because of those holes in the marketplace plans. Remember again, the COBRA plan has that PPO network where you've got in-network coverage and out-of-network coverage. This CareSource plan, while it does cover their prescription and it does cover the local hospital, it doesn't have that out-of-network coverage. So what I always recommend for my early retirees, especially this example of the Smiths who were wanting to travel, is to make sure that you have a supplement that covers you outside of your network as well in the case of injury or illness. So that adds a little bit of a cost of another $400 a month for a no network restricted supplement to be added to their major medical to assist them in case they needed to seek medical treatment outside of their network. Mr. and Mrs. Smith were also getting dental and vision through their job, but they didn't want to deal with COBRA for that either. So we had them go into their dentist's office, ask their dentist which dental plan that they would prefer them walk in with, and that's what we signed them up for. It happened to be through a company called Manhattan Life, and it was $90 a month for the both of them to get dental and vision. All told, we were now able to get Mr. and Mrs. Smith an $1,100 a month health insurance package that covered their prescriptions, covered their preferred doctors and hospitals. It covered them for out-of-state and out-of-network injury and illness, and it covered their dentist and their eye doctor, all for $1,100 a month, as opposed to the COBRA price tag of $2,000 a month, and this is a configuration they can keep until they hit 65. The reason we were able to do this is because we leveraged advanced premium tax credits through the marketplace. We used the new lower income that the Smiths were going to show to use these tax credits to lower our monthly premiums. You're not allowed to use those tax credits on COBRA premiums, but you can use them on the marketplace. So just make sure that your current doctors and hospitals, your current prescriptions, that they're in network. Make sure you get a supplement in case you need to travel and in case you need to go outside of the state, and make sure your dentist and eye doctor are still in network. And you can see you can save a ton of money. That's over $10,000 a year in health insurance premiums. So a lot of people think, hey, this looks great. I don't have any idea how to do any of this. You make it look so simple. How do we work with you? What does it cost? Working with an insurance agent like Iconic Insurance costs the consumer nothing. Our payment is built into the price tags of these products. And so our only allegiance is to you and making sure you are happy, because our payment depends on you keeping the plan for as long as possible. Then a lot of people say, well, Matt, hey, it was great working with you, but I'd rather work with you long term. What happens in 3 years when I hit 65? That's when we break down Medicare to you. We break down Medicare Advantage plans. We break down the traditional supplements, the drug plans, dental and vision. We break down long-term care. We walk you through all the different areas that you need to be paying attention to Medicare so that this cost goes down even further and your coverage will get even better. So when working with us on your early retirement, our main number one goal, our ultimate priority, is to get you from your retirement age to 65 safe and sound without a financial catastrophe from some type of healthcare expense. Because once you hit 65, we'll walk you through the Medicare process and you're home free.